An ADU can create rental income, family housing, or flexible living spaces. But the wrong financing can turn a smart project into an expensive monthly burden. Before choosing a contractor, answer three financial questions. First, how much equity can you access? Second, how will your contractor need to be paid? And then third, what monthly payment can you comfortably carry before the ADU starts producing income? Let's start with equity. Your equity is the difference between your current home value and what you still owe. But having equity does not mean you can borrow all of it. The lender will review the appraised property value, your current mortgage balance, your income, credit, and total monthly debts. Here's a simple example. Your home may be worth, let's say 900,000, but you still owe 600,000. That means you still have about $300,000 in total equity. But your available borrowing amount will be lower. The lender requires some equity to remain after the new financing closes. Now, once we know what you can access, we compare three options. The first option is a HELOC, a home equity line of credit, and it is secured by your home. It's a second loan. It leaves your current first mortgage completely in place, and that is definitely valuable when your existing mortgage has a low interest rate. And a HELOC can work well for an ADU project because construction expenses usually arrive in stages. So you may need money for the plans, then money for the permits, then the foundation, framing, electrical work, and finally, interior finishes. With a HELOC, you generally draw funds that are needed. You usually pay interest only if you choose that option on the amount used, not the entire approved line. There is a trade-off. Most HELOC rates are variable. The payment may increase when the interest rate changes. Some HELOCs also begin with a minimum draw with an interest-only payment. Later, the payment may include both principal and interest. That future payment changes must be reviewed before the construction begins. Your second option is the home equity line, sometimes called a HE loan. This is also a second mortgage. Your existing first mortgage stays in place. The major difference between the two are how the funds are delivered and fixed rate. A home equity loan provides one lump sum and it's a fixed rate which has predictable monthly payments and principal and interest payments. Now, this may be a better fit when your plans are complete, your bids are firm, and you know the full amount required. Now, you begin paying on the entire loan even if the contractor has not used everything. Now, that can create some unnecessary interest expense during a delayed project. Your third option is a cash out refinance, and this replaces your current first mortgage with a larger new mortgage. The difference comes back to you as cash after paying the existing mortgage and eligible closing costs. This may provide one larger loan and one monthly payment, but do not focus only on the cash received. You must compare the new interest rate with the new monthly payments, the closing costs, and the total long-term costs. Also, are you going to consider how long you're going to keep this new mortgage? If you currently have a very low mortgage interest rate, replacing the entire first mortgage may cost considerably more than financing only the ADU project separately. Now, here's an important warning. Do not base your financing amount only on the contractor quote. Your complete ADU budget may also include architectural plans, engineering permits, utility connections, soil or drainage work, appliances, landscaping, and contingency reserve. Construction delays can also extend how long you carry the additional monthly payment without receiving your rental income. Now let's discuss ADU rental income. Fannie Mae's current guideline applies to rental income from an existing ADU. The property must be, in most states, a one-unit primary residence. The transaction must be a purchase or limited cash-out refinance. It does not allow ADU rental income on a cash-out refinance. Only ones that have ADU incomes may be considered that you can use it for your qualifying income. However, it cannot exceed 30% of the total qualifying income. Now, additionally, rental income documentation and underwriting requirements also apply. Fannie Mae rule does not automatically control every HELOC or HELOAN. Those lenders may use their own qualifying guidelines, and that is most important if the ADU has not been built. Do not assume future projected rent will help you qualify. Confirm the income treatment before selecting your financing structure. So, which option may fit your project? A HELOC may fit a project with stage expenses and an uncertain final cost. A home equity loan may fit a firm budget when payment stability matters. You have the last is a cash out refinance may fit when replacing the entire first mortgage, which also what? Support your broader strategy. The correct decision is not simply which loan is the lowest starting payment. It is the option that protects your current mortgage, matches the construction schedule, and remains affordable. If the projected costs more or it takes longer, it can create a monthly nightmare. I've created a home equity options guide with an ADU insert, and it will help you compare these three financing paths. Comment the word equity below, and I'll send you the guide before you sign an ADU construction contract. Confirm the financing structure first, and the project should fit your mortgage strategy, not force your mortgage to fit the project.